Basically, so in 2020, there's that combination of fiscal and monetary stimulus. So basically, rather than, the past decade, a lot of the money printing we saw was mostly kind of stayed in banks, right? They increased the base money to prevent kind of deflation and bank failures, but they didn't just send tons of money to people. Whereas in 2020, they directly sent money to people, but in order to afford all that bond issuance without kind of choking out the markets, the Federal Reserve just created more base money to buy those bonds. And so that's outright money printing, quite inflationary for asset prices and for consumer prices. And now they're trying to rein that in by tightening their own balance sheet, by raising the cost of capital. And the challenge is that like you said, with the fiscal deficit still going on, but just no longer being monetized, but still happening, it's kind of crowding out the private sector. Like basically, the Federal Reserve's their tools are not really designed to deal with fiscal deficits. They're mostly designed to deal with the rate of bank lending. So they're primarily focused on, kind of reverse wealth effect, suppress bank lending, to kind of slow down money supply growth from that angle. And it is being challenged by how much fiscal activity is still happening.
In this insightful discussion with financial expert Lyn Alden, we gain a deep understanding of the intricate balance between fiscal and monetary policies in the face of economic challenges. Alden highlights the unprecedented approach taken in 2020, where direct payments to individuals were made, diverging from traditional methods of preventing deflation and bank failures. The consequence? A surge in inflationary pressures on asset and consumer prices. However, the Federal Reserve is now facing a complex dilemma. They're attempting to tighten their balance sheet and raise the cost of capital to counterbalance the ongoing fiscal deficits. The discussion delves into the intricacies of these monetary policies, shedding light on the Fed's attempts to manipulate bank loan growth and balance the economy. Furthermore, the conversation touches on the energy sector, specifically oil markets. Alden discusses the limited supply growth due to reduced investments, making energy inflation a looming concern. The interplay between energy prices and other risk assets underscores the need for diversification in investment portfolios. As the conversation unfolds, Alden explores the potential disruption factors, like war financing and oil supply security, that could further impact the market dynamics. Now here's Lyn Alden with her economic outlook.
Yeah, so they don't directly control the broad money, but they have these various ways to slow down or accelerate bank lending. And by raising the cost of capital so much, it makes borrowers a lot more hesitant to borrow money, or unable to afford things that they would have otherwise done. And so that in theory slows down bank loan growth, and that's what we have been seeing. They've been slowing down the rate of bank loan growth, and then they're also doing quantitative tightening. So they're selling bonds back to the market by letting them mature, and then instead of reinvesting those, they just basically delete that cash, and then the private sector has to buy kind of the reissued bond. Also, the shocking thing about TLT is it's not levered. That's literally just treasuries. The reason it's so volatile is those are very long duration treasuries. And so if a very long duration treasury goes from 1% yields to 5% yields, for example, that means the price has gone down significantly. Um, and right now, the Fed doesn't really have to do anything about it. I think the issue kind of starts maybe next year, where this rate of treasury issuance is still going to keep happening. And I think eventually they're just going to be unable to keep tightening their balance sheet. It's, kind of like basically the limiting factor is that if the treasury market goes illiquid, that's generally when the Fed steps in, right? So right now, the treasury market, even though the prices have gone down significantly and the yields have gone up, the market is still functioning. There's no problem with treasury auctions. There's no problem with like the secondary market seizing up in the way that it did, for example, in March 2020, and in a way that the repo market did back in 2019, and the way that the gilt market did, the UK bond market did back in about a year ago in kind of autumn 2022. As long or until those conditions happen in the treasury market, the Federal Reserve is able to kind of keep their tightening effort up. I view this as a disinflationary cycle within like a longer context of inflation. And so I don't necessarily see it as a sharp period of disinflation, because with this much fiscal deficit still pouring into the market, like $1.7 trillion in annualized deficits, it's pretty hard to have a deflationary shock. Now, I think certain parts of the economy can, like commercial real estate, and that's kind of already happened in some aspects. But basically, it's like two powerful forces hitting in opposite directions, which is a little bit different than some of these prior deflationary shocks. So I see more of like a stagnation. But it's something I keep monitoring because there are a lot of things here that are either unprecedented or not seen since like the 1940s in terms of the macro environment. That will depend on to what extent they break out. So if anything disrupts oil, for example, Iranian oil, that would certainly have a major effect on the market. Even the heightened risk that oil could be disrupted already results in higher oil prices, at least temporarily, as investors kind of change their probability assessment of oil supply security. Apart from that, war financing is another additive for deficits. It also basically ensures that like defense spending is not going to be going down. That's not one of the measures they're going to be using to reduce the fiscal deficit. And so I think it just kind of it's just like a small thing that adds to the existing issue, and with always like the risk that it could grow. Yeah, so I'm a long term oil bull. At kind of look when I look out the next 5 years. Ever since kind of the COVID crash, I've been kind of very constructive on the oil markets, especially as we saw a real recovery by like 2021. Um, and basically, there's a supply side limitation. There's just not been a lot of investment in the supply side, and there's only almost all of the marginal growth has come from U.S. shale, and that is basically it depletes very quickly. You have to keep drilling in order to maintain the rate of production you have, let alone keep growing it. And a lot of that's kind of reaching, not maybe its high point, but it's closer to the high point, I would argue, than it is kind of at its starting point. It's now a mature asset, at least in this kind of technology cycle. Um, and so I do think that energy inflation is going to be an ongoing risk. Now, the next 6 months is very unclear because you have to pair that with the possibility of demand destruction. If you have very tight interest rates and you're trying to slow the economy, and not just the US, but also China, Europe, um, that can eat into oil demand. Um, but longer term, I do think that energy prices are going to be a problem, and if they go up significantly, that eats into other things. And the way I would kind of phrase it is when we have a macro environment like we have now, stocks and bonds tend to be more correlated. So instead of being like the inversely correlated assets they used to be, they're now more correlated. And I think in some ways, energy is the hedge for other types of risk assets, which is energy can do well when other things are doing poorly, and energy can do poorly, which allows other things to do well. And so I think that's a useful portfolio diversifier for people. I mean, so it's possible. I mean, in some ways they seem more unified than they have been in a while. They're already not even meeting their targets. So normally the history of OPEC is that they set kind of quotas, and then countries in some ways try to overshoot a little bit, like kind of cheat a little bit, and produce a little bit more oil to kind of capture that, because it's kind of like a tragedy of the commons type of thing. If you can cheat a little bit and get away with it, it's the optimal kind of solution. Um, but in the recent environment, a lot of them are actually undershooting their quotas. Because they have a similar problem with shale, not in the sense that it's a fast decline rate, but in the sense that a lot of them have, for the amount of capex they've put in, it's hard to get a lot more oil out. Um, Saudi Arabia has spare capacity, but I would argue that the other ones are kind of tight. And so I think in some ways, that's less important, and it's more important about what Saudi Arabia does. They're kind of the fulcrum there, in terms of they can affect oil markets, whereas the organization as a whole, I would consider somewhat less influential than it was, decades ago.
There you have it. Let's summarize what Lyn Alden said. She discussed the pivotal events of 2020, where an unprecedented combination of fiscal and monetary stimulus unfolded. Unlike previous years, direct payments to individuals sparked inflationary pressures on asset and consumer prices. The Federal Reserve's efforts to manage this situation involved tightening their balance sheet and raising the cost of capital. However, the ongoing fiscal deficits posed a significant challenge, crowding out the private sector. The conversation also explored the dynamics of the Treasury market. emphasizing its crucial role in the Federal Reserve's strategies. Additionally, the discussion delved into the energy market, underlining potential challenges and opportunities, especially in light of limited investments in the supply side. Furthermore, the conversation touched on OPEC's role and challenges, emphasizing the importance of staying informed for making sound investment decisions. Thank you for watching. Stay tuned for more insightful discussions on our channel. Don't forget to like, share, and subscribe for the latest updates. See you next time.